Mastercard is one of my best performing stocks ever. Mastercard has a duopoly together with Visa and controls over 80% of the US credit card network market. The company's done really well for itself, and the stock price has returned more than 9,600% since 2006. The stock trades under the ticker symbol MA. The company has a market cap of $409 billion US, and it trades on the New York Stock Exchange. The company offers a small dividend yield of 0.6%. However, it is fast growing, as you'll see pretty soon. So here we can see the dividend per share, and we can see that it's a fast growing dividend with more than double-digit growth every year pretty much. And the latest dividend increase was roughly 15%. So this is a real fast dividend grower. And that's what I really like about Mastercard, that they do keep on increasing the dividend year after year. Another thing which I think is very impressive about this company is that they have been able to reduce the amount of outstanding shares over time. So you can see here on the left, in 2014 they had 1.1 billion shares, and now in the latest quarter, 2023 Q3 here, they had 950 million shares. So about 200 million shares have been deleted here. Now in terms of net sales of this company, we can see on the left side that the company has had a sales of $9.5 billion here in 2014, but has increased here over time to roughly $24.4 billion here in the latest quarter here in 2023 Q3. And the latest revenue increase was about 12.6% here for the trailing 12 months. So a very strong performance here of this company. However, in 2020, we could see a small dip here of 9.4% here in the middle due to the COVID period. We're not going to dwell too much on 2020 in terms of Mastercard's revenue decline here, but it was certainly the cross-border volume here that went down, as you can see, by quite a lot here, which caused the revenues and earnings to go down dramatically due to cross-border volumes going down significantly, as you can see here on the table. And this is from their 2020 annual report. If we then look at the EPS of the company, or earnings per share development of this company, we can see that they have done really well for themselves here. So on the left side here, we can see that they posted a $3.1 earnings per share here in 2014. However, in the most recent quarter here, we can see that they posted a 11.5 EPS here for Mastercard, and we can see that the latest increase was roughly 14.5%, and they've held a pretty high track record here of double-digit numbers here, with the exception here of 2020. Looking at the profit margin here, we can see that the company is posting a very, very strong profit margin here at 44.9% here for the most recent quarter here, 2023. However, it has been as low as 31.3% here, but do remember that these profit margins are really, really strong regardless. And it's these type of margins that I just love about this business. I mean, this company is just printing cash basically for their shareholders, and we're going to check this very soon as well when we're going to view the free cash flow of this company and the cash flow situation. But it's just an amazing business this Mastercard company has produced and has become. Looking at the cash from operations here, we can see that the company posted a $3.4 billion here in 2014 and has increased the cash from operations ever so slightly every year here. And we can see in the most recent quarter here, they're actually down a little bit. So 10.9 billion down from 11.1 billion or 11.2 billion almost here for 2022. So it's going to be interesting to see if they can increase this cash from operations once the year has ended, as we still have one quarter left of the year here. But this is just an amazing growth here over time, and we can see that the company has done very well for itself also in terms of cash from operations. Now to the net debt situation here, and we can see that Mastercard actually do have a net debt here of $8 billion here, as we can see in the most recent quarter. However, they have come from a situation where they had no net debt at all here, as we can see in 2014, where they basically had more cash. But management has decided to utilize this cash for other measures here rather than just keep it on the balance sheet. So that's why Mastercard now has a net debt, and it's not wrong, because I mean, I think that this company can pay off their debt in no time basically, as we'll see here very soon. And now for the capex side of the cash flows here, and we can see that they spent roughly $1.5 billion here in the most recent quarter and have done so here in 2022 as well. And it looks like it's pretty much in line with how it looks like in the past too. However, here, as we can see in 2021, they spent a lot of money here, almost 5.3 billion US dollars. But as it is right now, it's much less than that, of course, so it looks pretty stable to me right now. And now for one of the best parts here of this video, and this company certainly, is the free cash flow. And this company is just a free cash flow machine. They're generating a lot of cash flow, as you'll see here pretty soon. So here we're looking at the free cash flow margin, and the company has done very well for itself, posting a 40.2% free cash flow margin right now in the most recent quarter. However, it's been higher here, as you can see in the past. However, in 2014 it was much lower here at 32.4%. So over time they have increased the free cash flow margin, even though it has been a little bit higher here in the past few years. And here's the total cash flows, and we can see that the company has grown the cash flows here from 3 billion here in 2014 up to almost 10 billion here in the most recent quarter. However, it is down a little bit from 2022, where we can see that they actually had above 10 billion here in terms of cash flow or free cash flow for the company here. And we can see the only real decline here year over year is 2020, where we know that they struggled during, the travel restrictions and so on, and cross-border transactions. So we already know that, but except from that, or apart from that, we see that it's grown pretty nicely over time here. And many investors do forget that it's actually the per share metrics which is important. So that's why we're also showing you here the free cash flow per share as well. Because let's not forget that this company is actually buying back a lot of shares. So even though they may not increase the free cash flow overall, it could be the case that they could still do it per share. We can see here the growth over time. So they've gone from a 2.6 free cash flow per share in 2014 to 10.3 free cash flow per share in the most recent quarter. I think we've gone through most of the important financial metrics, so now we're going to look into some of the valuation metrics here. And the first valuation metric here will be price to earnings, or PE ratio, and the company has a pretty high PE ratio compared to many other companies. So currently it trades at a 38 times PE ratio here, which is actually quite in line with what it's been for the past couple of years. However, you could have bought this company a lot cheaper here, as you can see in 2014, 2015, or 2016. But let's not forget that this company is a fast-growing company as well, so that's why it kind of trades at a premium, is my opinion. Next, we're going to look at the enterprise value to EBIT, or EV/EBIT, as many people say. And here we can see that the company is currently trading at a 30 times multiple here, which is kind of high actually for a company in this size. However, we can see that it's been pretty much in line with how it's been the past couple of years, and it's actually been trading much higher here in 2020, as we can see. However, looking back again at 2014, 2015, 2016, you could have bought this company below 20. So this could indicate that this company could be a little bit overvalued right now, but we have to still remember that this company is still growing very fast. And with any fast growing company, there is a possibility that the valuation will, fix itself over time. And now for the final metric here for valuations, we'll look at the enterprise value to cash from operations, and we can see that the company currently holds a pretty high valuation here as well at 38.6 times, which is in the higher end, I would say. So this could indicate that the company could actually be a little bit overvalued, but we can see that you could have bought the company here in 2015 for like 24 times. So currently it is on the higher side of this valuation for sure. And here are some risks for this company that I think are very important to consider before investing in this company, or if you're owning this company already. Being this big as Mastercard is, they face a number of risks, including, increased scrutiny from regulators, changes in interchange fees, compliance with new regulations, and potential for fines and penalties. And it's not easy to be in a duopoly with Visa card or Visa in terms of these, regulations, because they are so big, so they have to be monitored and regulated often here. Another big risk here is the valuation metrics of this company, and we can see that the company does trade at a pretty high PE ratio here, 38. the EV/EBIT at 30 times, you know, the EV to cash flows, you know, 39 times, EV to free cash flow 43 times. And what these numbers have in common is that they're just high valuations. And I think that the investors, you know, owning this stock or looking at this stock potentially here should be aware that the company, you're paying a premium for this company when buying stocks or owning this company compared to many other propositions out there. So I think that can be good to know, that you're not going into this company with a margin here at a short-term price here. So, you know, be aware of the price here and valuations, certainly. The positive thing is the duopoly of this company that they have together, Visa, but you know, sometimes it can be the case that, you know, not chasing the number one in the same sense because you are so dominant could sometimes be risky. Having a strong competition, you know, eliminates much of the fat and happy situations where, you know, where companies just sit back and relax because they know that they're just so dominant. And this means that some of these companies stop innovate after a while because they think that why should we, you know, plow down a lot of money into capex or innovation when we are number one? We don't have to. Look at our margins. We are good as we are. We don't have to improve. And this can cause a catalyst of many bad examples and many bad decisions going forward. Owning Mastercard means that you're also sitting in the same boat as many of the super investors here, as you can see. So among those super investors is Chuck Aker, who holds roughly 21% of his portfolio with Mastercard, Valley Forge Capital 20%, Guy Spears actually owns almost 13% of Mastercard in his own portfolio. So you can see that many of the Mastercard owners are very good investors here, as you can see, with very good track record. And I think that this company will do well in the next 5 and 10 years, considering that they are in the digital space as well. So I think it can just be good to know that, you know, many super investors do like this stock. The only exception here would be Viking Global investors that have reduced their share of 71% in the stock. But as you can see, their percentage was pretty low to begin with. So, you know, I don't know. They did probably not have a very strong conviction about this stock anyways. If you want to help the channel grow, please do send a like below and also subscribe to the channel. Thanks a lot for watching, and I hope to see you again soon.